I'm talking about the shopping mall. We're going to look really closely at the shocking reality of mall economics. Like, how exactly does a massive structure filled with dozens of different businesses actually function financially? What keeps the lights on? And, maybe more importantly, what happens when those lights go out? We're going to examine the very real, hard, mathematical reasons why some of these giant properties thrive, and why others just fail so completely.
Okay, let's dive into this. Take a look at the trajectory of a real-life property that, back in its 1990s peak, was actually 98% occupied. Just picture it for a second. 5 massive department stores, over 140 thriving shops, packed parking lots, a bustling movie theater. It was literally a goldmine of commerce. But contrast that with what happened next. Less than 20 years later, that exact same building on that exact same plot of land went completely dark. We're talking rain pouring through broken skylights until it eventually became a literal pile of rubble. So what actually killed it? And why does this exact same sequence of events happen to malls all over the country?
Well, to understand how this happens, we first got to wrap our heads around the sheer scale of the initial investment. Because you're not just buying a building, right? You're buying a bet on a whole neighborhood. Building a large mall from scratch involves absolutely staggering upfront costs. You're acquiring vast tracts of land, pouring endless amounts of concrete, setting up incredibly complex wiring, and building massive parking structures. I mean, the permits and construction costs alone can easily run into the hundreds of millions of dollars before a single store even opens its doors. And if you're buying an existing top-tier, Class A mall, the ones with luxury anchors and giant wait lists of brands desperate to get in, that can cost well over $1 billion. It's just a massive financial undertaking.
But then, you have the other end of the spectrum, $2,750,000. Contrast those billion-dollar valuations we just talked about with this incredibly low figure. This was the actual sale price of a mall in Akron, Ohio, called Rolling Acres, back in the early 2000s. And what makes this so devastating is that the owner right before that had paid over $33 million for the exact same property. This dramatic cliff dive collapse in value just proves how incredibly fragile this billion-dollar investment bet really is.
Section 1. How a mall actually makes money, the revenue engine.
So, rent in a mall is never just one simple number. It's actually 4 distinct layers of revenue stacked right on top of each other. First up, you have the base rent. Second, a percentage of sales. Third, common area maintenance, which is usually just called CAM. And fourth, the money generated from parking, kiosks, and ads. For a mall owner to actually turn a profit, every single one of these streams has to flow properly.
Now, what's really interesting about this slide is the massive disparity in that first layer, the base rent. Anchor stores, like the huge department stores, were reportedly paying around $5 per square foot. But meanwhile, the smaller shops right next door in the exact same mall were paying $50 to $60 per square foot. Crazy, right? Well, why? Because the anchor store isn't really renting space, it's selling foot traffic. Those massive anchors draw the crowds, and every single smaller store is quietly subsidizing that heavily discounted rent for the anchor just for the privilege of accessing those crowds.
Once you have your base rent established, you add the second layer, percentage rent. So once a store's sales cross a pre-agreed threshold, the mall literally takes a cut of everything they sell above it. Then we have the third slice, CAM, which are the maintenance fees split among the tenants based on their share of the building. And finally, that fourth slice, parking, kiosks, and ads. This part is fascinating because a tiny little kiosk sitting in a busy walkway can actually out-earn a full-size store on a per-square-foot basis, simply because it's positioned exactly where the highest concentration of foot traffic is.
Section 2. The hidden trapdoor, the fatal flaw.
So, the crucial point is the co-tenancy clause. This right here is the secret trapdoor that most people outside the commercial real estate industry have absolutely no idea exists. Buried deep in most mall leases is a clause that essentially says if a major anchor store closes its doors, the smaller stores around it can legally and immediately cut their own rent. Or, in some cases, they can break their lease and walk away entirely. So one anchor closing doesn't just mean you have a big empty space, it turns into a total mall-wide rent collapse.
To illustrate just how devastating this ripple effect can be, let's look at the number 59. Back in 2018 when Sears filed for bankruptcy, one major mall owner had Sears anchor stores in 59 of its properties. And because roughly 80% of all Sears stores were located in regional malls, a single corporate bankruptcy triggered devastating rent cuts across dozens and dozens of smaller stores in the same buildings. It's wild to think about, but all of this financial destruction was triggered automatically because of contract language that had been written decades earlier. Section 3. The autopsy. Rolling Acres.
Rolling Acres actually opened its stores in Akron back in 1975, and by the mid-90s, it had hit its absolute peak. We're talking 5 anchors, 140 stores, and 98% full. But then a newer mall opened nearby, 1 anchor relocated, another anchor rebranded twice, and then just closed for good. And guess what? Those co-tenancy clauses fired. By 2006, this building, which was once worth over $30 million, crashed to a valuation of just $1.6 million. Fast forward to 2013, and the very last tenant closed. The abandoned building was stripped by scrappers for its copper wiring, vandals destroyed the skylights, and rain literally rotted it from the inside out. Eventually, the city seized it over unpaid taxes, and it was demolished in stages between 2016 and 2019 to make way for an Amazon distribution center. So it took less than 2 decades to go from packed and thriving to total demolition.
Section 4. The evolution. The malls that survived. And this brilliantly illustrates the exact pivot these survivors had to make. Online shopping permanently broke the mall's original monopoly, which was, of course, convenience. So, surviving malls realized they had to change completely. The old model was all about selling products and convenience. The new model? It's about selling reasons to show up and experiences. Malls stopped relying entirely on shelves of products and started offering things a screen simply cannot deliver. They basically replaced traditional retail stores with restaurants featuring real tables, state-of-the-art gyms, urgent care clinics, modern co-working spaces. Some even built apartments right into the old, empty anchor boxes. But make no mistake, this evolution is incredibly expensive. $100 million. One major mall owner spent this massive sum over the course of 3 years just to subdivide a single old department store into 4 smaller, experience-based units. It requires really deep pockets and total reinvention. But it works, because the entire goal shifted from just filling retail space to giving people a compelling, physical reason to actually leave their houses.
Which brings us to our bottom line summary of mall economics. The building isn't the business. The people walking through it are. In a good year, with strong anchors and a healthy tenant mix, a mall produces incredibly steady, predictable income and rising property values. But in a bad year, when an anchor leaves and those co-tenancy clauses fire, well, the fixed costs of owning that massive building, things like taxes, maintenance, insurance, they don't shrink just because the stores do. Rolling Acres lived through both versions of that story in the exact same building, just a decade apart. The concrete and steel never changed, but the underlying economics dictating its survival absolutely did. So I'm going to leave you with this final, provocative question. Would you ever bet on owning a mall? Considering everything we've just learned about the sheer fragility of foot traffic, those massive upfront costs, and the hidden trapdoor of co-tenancy clauses, it certainly changes how you view these giant buildings in your own town, doesn't it? If you found this autopsy of mall economics insightful, make sure you subscribe to The Explainer for more deep dives into the real, hidden economics behind the everyday businesses around us. Thanks for joining me, and I'll catch you next time.